Okay, I believe everybody's here. So, hi, Tarun. How's everything?
Hey, how are you guys doing?
Great, great. So, welcome everyone. Today, we're very thankful to have both Sergey and Tarun here with us. So, why don't we get started off with our introductions right away?
Sounds good. Hey everyone. Hey Tarun, how are you doing?
Great, can't complain. It's finally not winter here in New York, so
It's getting warmer for sure. Yeah. Do you want to kick off
sure. Yeah,
with an intro?
yeah,
Yep.
sure. So hey everyone. I'm Tarun, founder of Gauntlet and also investor at Robot Ventures. And I've spent a bunch of time thinking about sort of different things in the cross-chain world, and excited to talk with Sergey about them.
Awesome. Great to have you here. Yeah. Hey everyone. This is Sergey, one of the co-founders of Axelar. So pretty excited for today's AMA. Awesome. Why don't we get started? Well, actually, Tarun, do you want to maybe kind of go first and tell us a little bit more? What do you do in most of your days? I know you write some papers, you talk to many projects, you invest. Yeah, why don't you tell us, like, how does your day look like?
Yeah, so I 90% of my time, 95% of my time is actually really running my company. And, what we do is we kind of help DeFi protocols optimize their parameters. How do you choose interest rates? How do you choose margin requirements? As a sort of, we're kind of constantly monitoring what's happening in the market. And then when there's sort of something that's changed to something that's kind of like a big event that maybe means that a DEX or a lending protocol needs to adapt their parameters. We kind of submit the governance proposals and work directly with DAOs. So that's the majority, but part of that job also involves doing a lot of research on formalizing DeFi protocols, because if you're going to try to understand the risk or model sort of the incentives in these systems, you have to have a more sort of formal mathematical framework so that you can actually try to say, okay, I can like match this framework to data, see what people are doing in reality relative to this model, see where it works, see where it doesn't, and then based on that, make some predictions about protocol behavior or risk, things like that. So, and then I also invest, but I'm mainly a founder who invests in other founders, not really a VC leading rounds. But yeah, that's sort of the rough way I describe how I spend my day. And a lot of times I am basically just scouring through reading people's code and also papers to try to figure out if there's like some sort of meta level math problem that people are solving, but like kind of in slightly different ways. And that sort of led to our series of papers on formalizing how certain types of automated market makers work. And of course, definitely am searching for some cross-chain problem that makes a lot of sense to formalize.
Awesome. What's a good example of a DeFi project that you guys helped? I don't know if you can talk about it. I'm curious, like, if there's a specific parameter that you're most proud of, or an optimization that you guys did that would have, I don't know, led to devastating effects otherwise.
Yeah, I think in sort of early 2020, there was sort of this very contentious compound. So we work with with a lot of lending protocols on sort of monitoring collateral factors, and collateral factors are sort of the equivalent of margin requirements, like how much collateral do you have to post in order to take out a loan. And at that time, it was actually very contentious that, hey, we're trying to argue that we need to make a collateral factor change that would cause, at least for a small number of loans, them to have some partial liquidation. And so there was a lot of contention over whether it was a good idea to do that or not. We eventually prevailed. I think people were convinced by sort of the modeling and rationale, and then a month later, we were able to kind of like retroactively look at that choice and it definitely saved a few $100 million of liquidation. So that sort of was one that I would say pretty proud of. And then also, like, for AMMs, we do a lot of incentive optimization, and I think that's something where it's not about reducing risk, but it's actually about like increasing net revenue to the protocol without having to spend too much in acquisition costs, and so have done improved a lot of things, like in Sushi, helped him kind of make $20 million more for the LPs in the protocol.
Nice, awesome. So let's talk about cross-chain a little bit, right? And I guess I'm curious, when did you start thinking about cross-chain in general? I know for me personally, it kind of started a couple of years back when we shipped Algorand, and we're looking for various ways to connect it and kind of interact with other ecosystems. So with some of the early genesis that led us to build Axelar. But curious, what was it for you? When did it start?
I think it was really when I was trying to understand, maybe in 2018 or early 19, the kind of architectural differences between Polkadot and Cosmos, because I think at that time, no one was calling it sort of cross-chain or bridging or like sort of foreign function interface for different virtual machines. Instead, they were sort of calling it, app chains or pair chains or shards or whatever, right? And like somehow the communication layer was not fully specified. And I think like I went down the rabbit hole trying to understand why IBC was designed the way it was versus, say, the Polkadot version of the world. And at that time, I think there was a lot of stuff in the Ethereum world that was like extremely underspecified in terms of how shards would communicate with each other. And then, one type of thing I spent a lot of time thinking about was DDoS attacks against shards. So, in when I worked in high frequency trading, something that would oftentimes happen would be that the sort of gateway to the matching engine would someone would like send it a ton of messages and basically ensure that a bunch of orders could get added from other market participants because they didn't have like very good spam prevention mechanisms. And I was sort of imagining that you would have to have the same problem here, but somehow none of the descriptions of these things really explained how that works. So that was sort of when I really started spending a lot of time understanding, like, okay, like, what are atomic swaps? How does sort of like spam prevention work? How do you actually sort of economically coordinate this spam prevention, ensure people on both sides are incentivized? And, long story short, that was sort of my introduction. And partially because I came from sort of like a centralized distributed system background as an engineer, and I just felt like some of the specs were just not fully specified.
Yeah, I mean, even in I guess Cosmos or Polkadot, right? Even those protocols were, I think, still in development, right? I think Polkadot has still been shipped just now. I think in the last kind of month or plus and a half. I think IBC launched last year, right? So kind of when you started thinking about it, I think the whole space didn't even know how to think about it. But also at the same time, correct me if I'm wrong, sort of Cosmos and Polkadot and like the protocols around that, they're definitely focused to, those ecosystems, right? And kind of the design decisions and kind of everything else that went into those protocols were trying to solve either scalability issues or kind of growing composability within those sort of two ecosystems. Would you say that's correct, or what did you see back then?
Yeah, I think that's correct. I also think that at that time, and to some extent this is still true, of course, much less for Cosmos nowadays, that like both of those ecosystems were kind of, I wouldn't say anti-DeFi, but kind of were like, we want non-financial applications. And we're really focused on this idea of like, hey, we're going to have a world of applications that interact with each other, not a world of financial applications, because, I think the communities that built both of those protocols were sort of, again, a little more anti-finance in some ways. Yeah, it was really more focused on scalability and also like, how do you build decentralized Twitter versus like, hey, actually, you could like do sort of better atomic transaction guarantees for order books or like derivative exchanges or lending protocols. I think once DeFi started growing on ETH, though, that was sort of when I started to probably like late 2020 was when it started becoming clear that like the cross-chain world was going to be way more complicated than the raw ETH world, and I think that was sort of the time I noticed the Cosmos and Polkadot communities really actually realizing that, hey, we actually should be thinking about DeFi when we're designing these things, because that will be the first application no matter what.
Yeah, makes sense. And I guess, you know, also around those years, I remember there was a lot of talk about things like, you know, even atomic swaps, right? And I remember when we were starting out Axelar, people were like, well, can't you just do everything with atomic swaps and call it a day? And we had to, you know, convince people like, well, no, you know, atomic swaps are not going to solve your problems in composability. I guess, yeah. Did you see the same back then, or how would you think?
Yeah, I think it was definitely kind of interesting because there was still sort of this. I feel like in 2019 there was still a little bit of negative belief in the account model, right? Like there were like a ton of new like UTXO scalability chains that were, you know, promising a lot of things, and people were not totally convinced that we were going to end up with these kind of applications that were a bunch of shared global state, and also sort of some notion of like agreement on that state in a sort of economic manner. And I think like the invention of the Uniswaps of the world really kind of destroyed that thesis to some extent, and cross-chain world had to adapt to that, and then of course atomic swap in all of it.
Hey, sir, I think you broke off. Are you there?
Yes, sorry.
Okay.
I was saying the like Uniswaps in some sense killed the atomic swap, but this idea of needing global state and there's contention for just makes it impossible with kind of atomic.
Yep, makes sense. Cool. So sounds good. So I guess, you know, fast forward, right, a couple of years, we're now talking about cross-chain a lot more often, right? I think even a year ago, you know, it wasn't a theme to a larger extent. I think a lot of people, you know, still were thinking that, you know, Ethereum is going to upgrade and kind of take over and all the other chains are not going to matter. I think last year we saw a lot of that perception being changed, at least from my perspective. So, and we, you know, today we live in a world with different solutions, right, and different approaches. How do you think about them? How would you think about their security? And maybe let's start about security, right? Like, how would you think about cross-chain security?
Yeah, I mean, I think one of the first questions is sort of what is the collateral that exists in these systems? Because there's no way, in some sense, there's no sort of collateral-free system, fully collateral-free system that you can kind of go cross-chain with. Whether it's sort of a staking chain that's intermediating, like in the case of Axelar, whether it's sort of something that has some flavor of atomic swap, but it's sort of like you lock up collateral on one chain and sort of create it on the other, whether it's sort of wormhole-like where, well, in the wormhole case, more trusted, I guess, to some extent.
The bank is the collateral.
Start by thinking, yeah, exactly. Jump is the collateral. But yeah, I guess like first start thinking about A, what the collateral is. B, start thinking about what the collateral sort of quality is on its own without regard to the other collateral, like on the other chain. Then you start thinking about their correlation and, you know, what types of events would cause them to be correlated in a way that would mean that by the time you go across the bridge, the collateral you put down is worth less than the collateral you're taking out, and sort of what conditions would cause that. And then after that, sort of reasoning about the application level, value of like how much value are you actually transferring across this thing, and then finally sort of like what are the latency characteristics you care about. And that's sort of my Maslow's hierarchy of cross-chain security. Maybe not Maslow, but some other psychiatrist, financial
Nice.
psychiatrist.
Good. So I guess let's start with the first question, right? Okay, about this sort of collateral question. And I mean, it's not a question unique to cross-chain to some extent, right? Every time you talk about like a base chain layer and you have, validators that have something at stake or nothing at stake, you have instances of, applications or assets built on top that could have more value, right? That could have a lot more at stake at the application layer than what the validators have. So yeah, kind of curious how you think about the differences between this collateral, let's say on a proof of stake type of a system in a standalone environment, and what validators have at stake versus cross chain.
Yeah, that's a great question. I mean, I think one of the important things that has been clear from a lot of the sort of cross-chain attacks is, what is collateral might not be what you think it is, in the sense that, hey, maybe there's a synthetic asset that's representing the real asset, and they're supposed to stay pegged to be worth the same amount, but something happens such that they're not pegged. Either there's like a huge mint event, maybe some of the supply gets burned on one side, maybe there's sort of some other reason that the peg doesn't hold, like in the case of say a bridge like Synapse, where there's sort of curve pools on each side. If the curve pool doesn't have enough liquidity, someone can sort of do an oracle attack effectively. And so I think like one thing to remember is that you have to sort of think about what the actual representation, the remote representation on sort of the destination chain is of the actual asset you have. And in some sense, the question is, is it a synthetic? Is it native? And the second thing is, if it's yield bearing, how does the yield sort of accumulate? And are you paying sort of some type of premium to move your collateral across? And that's sort of more the financy way of thinking about it. I think from the computer science way, we have two machines that have different languages, and potentially they're not exactly bitwise identical, and they're not bitwise identical in a lot of ways. And so there's some translation that's being done, and if that translation isn't done with good enough fidelity in all circumstances, then you can have sort of things that are supposed to be equivalent on both sides not be equivalent. But there's sort of a duality of these two in these cross-chain systems, where you have to think of it both from the finance standpoint of the collateral should somehow be representable on both sides as the same thing, as well as sort of the machine translation piece needs to be things that are supposed to be equal on both sides should be equal on both sides.
Yep, that makes sense. And I guess, yeah, one of the things, we've been thinking hard about, as we're thinking about Axelar as well, is that how do you preserve all these functionalities through, a decentralized way, right? And through a decentralized protocol. I mean, you can certainly enforce some of these properties that you mentioned at an application layer or in a centralized way. So yeah, how do you think decentralized solutions versus, centralized approaches kind of compare for providing these properties?
Yeah, I mean, I think decentralized approaches just have to have one difference between the centralized and decentralized approach is that the centralized approach is effectively the user saying, I trust the collateral guarantee of this one entity, and I believe this one entity, no matter what, my collateral will be made whole, effectively. And I think, of course, we've learned on the multi-sig bridges, and we've sort of realized that, yes, they do need to be a bank on the other side, effectively. Someone has to act like a bank. But in the decentralized world, you have to have some way of people being able to pool assets to sort of do who are rewarded effectively insurance premia that the users are paying them, whether it's in staking rewards, whether it's in fees, etc., liquidity rewards. And those premia have to be able to aggregate a big enough pool of assets for sort of covering shortfalls if there is sort of one of these invariant violations. And I think, like, obviously finding the right incentive structure to do that, and also the right sort of hardware and cryptography infrastructure to do that is obviously the biggest thing that's difficult to get right in the decentralized world, right? It's probably easier. It's always easier to find capital than actual validators in some sense, like physical validators, not people who are delegated to and are representing multiple forms of capital. And so there's always this sort of discrepancy and mismatch between how much capital is being used for sort of this effective insurance or sort of validity guarantee, and how much capital is actually used for running nodes, for like actually doing the state transitions. And I think that makes it a lot harder, because in the centralized world, you just bucket that into one thing. You don't even like think about how you're paying the premium. You don't have to think about how you're calculating that quantity, and you don't have to think about how everyone has to agree on that quantity being calculated correctly. You just say, okay, well, I trust Coinbase, and if anything goes wrong, they'll pay me exactly what I put in. And so that's one of, I think, the biggest things, is that the design space, the sort of the state space of the system, really explodes when you make it decentralized, which is both a huge opportunity and also obviously a huge challenge.
Yeah, for sure. But I guess, one thing that with the decentralized, approaches, then the balance between sort of, the collateral that you have, or like what validators have, and what the value that you're securing, doesn't have to be, as sort of pegged as it is in the centralized systems, right? In the sense that, for instance, you look at, again, like proof of stake networks, let's say a Cosmos chain, right? Validators themselves have very little actually at stake, right, to secure the proof of stake network, other than whatever one atom that they put in there, and their reputation on the line. And if they get slashed, they get slashed with someone else's money in some sense, right? Kind of how do you think about that? Kind of what it is that the validators should have at stake? Should they not have anything at stake? And do you think decentralization in this case allows you to have more freedom about, I guess, economic decisions that you make, because the security relies on a decentralized validator set?
Yeah, I mean, I think they do effectively have to have something at stake, right? A maybe very boring TradFi example of this is, what is the reason that it's hard to become an insurance provider in most countries? Well, it's actually not that, like, in theory, right, to provide insurance, you could just go to someone, say, hey, look, here's a document that says, like, if some event happens, that gets universally agreed on, then I'm going to pay out a certain amount to you. And I can just write that document, give it to you, you can pay me a premium, and then I keep collecting it, and then reinvest it. Hopefully it covers. Well, one of the things that governments do is they force you to put up a ton of capital as a capital requirement with the government in order to get an insurance license. In some ways, staking is sort of the same thing, except there's not sort of as much red tape to allow the validators to effectively be placing their capital as a sort of form of insurance buffer. And I think one of the hardest parts in proof of stake versus proof of work is that to reason about is that in proof of stake, the applications on top of the chain can cannibalize the security of the underlying chain if, say, for some reason they're worth more, either like the assets on the underlying chain are worth, the assets in the sort of synthetic assets are worth more than the layer one. You can have all sorts of weird issues. But the other thing is sort of effectively vampire attacks, where an application promises more yield than the underlying base chain staking reward, and it sort of can cannibalize stake, and then maybe it's able to accumulate 33% in a pool, and then that pool can be used sort of in a deleterious manner. I think, like, one thing you have to think about is sort of the opportunity cost of capital whenever reasoning about these systems. And in the decentralized world, the opportunity cost is actually quite a bit complicated to reason about, because there's not really like some notion of like a risk-free. I mean, risk-free is always a funny phrase to use, but there's not a notion of like a rate that people agree on as sort of the minimum rate. And I think when designing these things, you have to think about the economics in that sense. Of like you need to ensure that you're compensating validators for locking up capital in a way that ensures that their opportunity cost is not that high.
Yep, for sure. Makes sense. Awesome. Sounds good. Well, now let's talk a little bit about MEV, right? Which I think one of the questions that everybody keeps on asking, and you certainly have. So just to define, for those that are listening, MEV is the miner extractable value, right? That's the kind of ability for the validators or miners to either influence the order of transactions or influence the order of events, right? To try to extract some value for themselves as they're processing or securing some of the underlying chains. So, and when we talk about kind of cross-chain, of course, these questions also come up. Yeah, so how do you think about it? Do you think it's a... First of all, maybe let's step back. How would you define a cross-chain MEV?
Yeah, this is actually a fun question, because people will get into fights over the definition of this. I prefer sort of defining it in terms of any type of excess profit that validators can get from adjusting transactions or adding or removing transactions in a way that's still consistent with the consensus protocol, but not consistent with users' intent. And intent obviously is very hard to specify when, say, transaction ordering is not up to the user, but their intent is not to be placed behind a big transaction. But in some sense, that's sort of the broad strokes definition of it. Another version of this may be that if validators see users submit a bunch of transactions and the transactions cause natural arbitrage, and the validators put in those arbitrage transactions. And arguably that, from an efficient market standpoint, isn't MEV, but I think, one of the places, say, maybe like the Flashbot community and, the Solana community would disagree, is that Flashbots would argue that's MEV. The miners earned a profit from executing that arbitrage by adding in a transaction. And in the Solana world, people would probably say that that's actually the market being efficient. Like, it's fine if the miner is the one doing it. Why does it matter if it's them or someone else? So there's a very fine line there, and this is why I use the nebulous concept of user intent. Partially because, I think on each network, each community has a different basic minimum viable understanding of what intent of a transaction is. In Solana, for instance, intent is actually quite different when there's sort of this no mempool behavior and you have to keep retrying your transaction, versus somewhere where there's a mempool, but you may have to kind of sit there and wait until the gas price returns to what you are willing to pay. So again, apologies for that not being a super mathematically formal definition, but I just want to point out that especially when you go cross-chain, the individual chains might have different definitions of what qualifies. And then for the cross-chain MEV, I think it's a little more simple once you kind of take that definition, is that you have a user's intent on one chain, and they make a transaction, and one of the validator sets of either chain decides to change the intent on either the source or destination chain, and change the execution with regard to intent. Now, again, because the consensus protocols don't agree, what the user may have submitted to the source chain, if it was for a source chain program, may have not been accepted by the consensus of the source chain. But yet it may actually have been accepted by the consensus of the destination chain, and the validator can take advantage of that difference in both consensus or virtual machine differences or things like that. So broadly speaking, user has an intent, validator adds, removes, reorders transactions, in a manner that goes against the intent and also generates a positive expected value for the validator.
Yep, awesome, makes sense. So, and I guess one thing when I think about kind of a cross-chain and MBV, you now could have potentially even multiple, let's say, requests or intents from multiple users, right, submitted on different, let's say, source chains that are all going to the same destination chain, to the same like application. So how would you define an MEV in a multi-user setting? And I guess the reason I'm asking is because, when a user submits an intent on a single chain, or it's one intent, you have sort of a notion of time, right? And you can kind of, say the transaction has went through. Yeah, what about multi-user setting? There's no global clock across these chains, right? Everybody runs like on their own consensus speed. Yeah, do you think the single user definition generalizes to multi-user or not?
Yeah, that's a great question. I mean, there's a sense in which going across chain is sort of time traveling because, you have no, but randomly time traveling because you have no kind of guarantees that the clocks are synchronized in any sort of even basic like Lamport clock style. You just sort of hope that the clocks are close enough up to some error. And you could be going back in time relative to a block you saw if, say, the destination chain reorged or didn't finalize correctly, like there was a view change. So the point is definitely well taken that like the multi-user setting and the multi-time setting, multi-ordering setting is sort of not is not even sort of a partially ordered set of user intents. But that being said, there is still a sense in which a user, if they were able to, in sort of imagine we're in sort of some futuristic world where the users could easily generate zero knowledge proofs of the state transition that they wanted. You could imagine there's a world where a user says, okay, I have both blockchains synced, and I have this transaction on the source chain, this transaction on the destination chain. I've simulated both of them locally, so I've executed them under what I believe the what I believe the environment is at the current time that I have perceived them, and I generate zero knowledge proofs of the expected output, and then I submit that alongside the actual transactions to the validators, and then I can measure if the validators actually executed and got me to that state. Now, I have no guarantees of getting to that state, of course. The environment could have changed. Someone could have very, very acceptably published a transaction or a block of transactions before the expected environment that I expected. But one question is, if I do that experiment repeatedly, a million times, what percentage of the time does the user generate a proof that matches what their expectation is? And in some sense, that's sort of the probabilistic definition of what user intent is in this multi-tenancy, multi-user, multi-clock world. Now, of course, it's like very hard for the user to do that, right? If you're a light client, it's not like you're going to be, trying to simulate what the expected end state of your transaction is. But I guess from a more thought experiment standpoint, or like if you were trying to formally define it, I would probably try to do it that way, because that would at least give you some notion of consistency. And so, something that where there's a lot of MEV, you would expect the probability that the user's proof matches the validator's proof to be quite low. Whereas, in a world where there's not much MEV, you'd expect those two to be quite the probability of those being the same to be quite similar, quite high.
Yeah, but even in that definition, right? I mean, okay, like again, like back to the multi-user setting, you can do it and you can simulate it locally, but assuming there is a lot of transactions and a lot of like other users, let's say, that are submitting something from other chains, if you have no visibility that actually most of the time that you simulate these things, you get the wrong, output, right? Then what the transaction will actually get when it's executed like on a destination chain, no?
Yeah, for sure. And it also, the problem here that's sort of confounding is it depends on application level complexity. So if you have something, say, like a Uniswap transaction or a CFMM transaction in general, CFMMs have this property that they're sort of this like translation invariance. If your slippage limit is really large, then no matter where in the block I place the trade will still execute provided there's non-zero liquidity, which is very different than sort of something like an order book, where if I say add an order to a certain price level, well, if the rest of the book has moved, greater than a certain number of ticks away from that where that add order was defined, my order might be invalid. Whereas in the case of like these Uniswap LP shares, non-concentrated, it actually sort of has this like translation invariance, and the translation invariance corresponds to how sensitive you are to time execution, right? Because you can get executed in any slot at any time, provided there's this bare minimum constraint of non-zero liquidity. Whereas for a more complicated application, there may be much more long-range dependencies, right? So like, let's say there's a program that relies on an oracle, and when the oracle upgrades it, it goes through and marks every order in an order book. And then that, based on the marks that it has, it goes and liquidates some of them. Something like that is extremely sensitive to where in the block an order was updated. Maybe there's a user is sending a cross-chain transaction that is saying, hey, I'm adding margin. I'm putting up ETH as collateral on ETH. I'm minting wormhole ETH on the other side. I'm adding wormhole ETH to my lending pool collateral base. And because I think there's going to be an Oracle update that's about to liquidate me, well, then that's not time translation invariant, right? That depends on the sort of order translation invariant. That actually depends very strongly on precisely whether I get executed before or after the Oracle update. And I think one of the reasons defining this sort of multi-user case is even harder is that it is quite application specific. If you try to define it in a purely non-application specific manner, you will basically be forced to have this kind of very ugly, like, hey, I'm trying to say, like, what's the probability that like two users get to, let's just say it's a 2-user case. What's the probability that 2 users, both simulated locally, and within up to some error, the final state that's output for them is equal to what they initially simulated locally. It ends up being like a very, very hard thing to reason out for like a generic calculation that you're making, a generic computation. But I do think in the application specific instance, when you add in constraints like this, like order invariance type of property, or some type of notion of like locality sensitivity of your transaction, you can maybe get something that makes more sense. If that makes sense. So it's a bit of a cop-out answer, right? I'm saying, hey, it has to be application specific, and you may have to add in these constraints. But I think the most generic version ends up having this problem of you would effectively have the thing where you're taking the product of, this product of all the probabilities that all the users get within some error of like the true state that they desire. And that thing obviously is extremely hard to control or reason about.
Yeah, for sure. I mean, I claim that you probably even can prove some type of impossibility result that you actually can't estimate it for some applications, right? Because you can't predict these things.
Yeah, exactly. And I think like this is the thing about CFMMs that, for me, someone who came from traditional finance and sort of a more probability and pure math background, that I find kind of like fascinating about CFMMs versus like order books, is that they have this like weird invariant property that their execution, you might get worse execution, but you will still get executed if you get front run. Whereas in an order book, that's not guaranteed. There's all these like very strong edge cases that like have this huge decision tree of whether the transaction's invalid or valid. And I generally think blockchain applications that work really well are ones that have these sort of loose invariance properties. And I suspect that to your question, like the applications you can reason about in this multi-tenant, multi-chain, multi-clock world are the ones that have some sort of properties like this, where they're not super sensitive in a certain way to these reorderings and addings and deletions, but only in some like local manner, like around the transaction that's sent, if that makes sense.
Yep, for sure, makes sense. So where do you think MEV should be addressed, right? you can address it on the source chain, you can address it like on, intermediary or connected chains that are moving the traffic. But it feels like, correct me if I'm wrong, but it, at least to me, it's protecting it at the application layer, right, before potentially transactions are executed, maybe is the right thing for some applications. Yeah, how do you think about it? Where should the MEV be addressed?
I think in the long run, we're going to have sort of some API/interface from the base chain to the application, where application developers can basically describe how they want the MEV execution to happen, like how they would enter an auction, let's say, like let's pretend it's just something like Flashbot's auction. The application developer says, like, this particular route, when this function is called, it sends a message to effectively the auction that says, like, here's a constraint, like any bundle that includes a transaction calling this function cannot do something of this form. It can't like put more than 5 of these transaction calls in a single bundle. And so you're going to have this sort of trade-off between searchers and sort of MEV finders. They have an API right now, right? That's a DSL. It's a very imperfect DSL, but it is a DSL that says, here is a bundle of transactions, here's a combinatorial auction, here's how I'm bidding on subsets of this thing, and I want to guarantee that this subset gets executed atomically, so either all at once or not, or killed. And there's no API for applications now, right? And so I think what will actually happen is app developers will be able to specify some constraints on their function calls and the call sites and sort of the local environment they're allowed to execute in. And those constraints will be, of course, dependent on each virtual machine where you're getting executed and also the intermediary that's ferrying those transactions. So I basically suspect there will be auctions or some type of mechanism of that similar form on each layer, on each leg. So there'll be an auction on the source chain, auction on the cross chain, auction of destination chain, and each transaction, each bundle is allowed, the application is allowed to effectively have some sort of API that's part of consensus that says this can't be executed, more like some constraints on their execution, even if reordered. And in some ways, like from a pure theoretical distributed system standpoint, this sort of forces these things we're talking about here earlier of like these like locality constraints. And again, I'm talking about this very informally, hazily. Like I don't think that there's a, I don't think I know exactly what the definition of them are, but it is clear that like successful applications somehow have that built in, and I think future applications will basically have to encode it. And the way they'll encode it is there'll sort of be some API that they can try to ensure that these auction processes or these kind of clearing processes have to follow. And, I think as people try to build these auctions into the layer ones themselves, we'll start to see that happen.
Yeah, makes sense. I mean, I could also see this like get complicated very, very quickly, right? Because, with many chains, with many even potential like hops of your transaction, to get from a source to a destination, like everywhere there's like this opportunity for MEV. And I could see these APIs get complicated, in the very, very quickly. So I guess here's my question. Do you think that's going to happen, or do you think people forget about and just give up on MEV and say that's a part of the business?
Yeah, I actually think the latter also has quite a big chance of happening, because honestly, if you just like look at MEV profits that have over time, it has cut down quite a bit, and then B, the application's front ends are basically sending transactions to relayers who are extracting the profit themselves and then splitting it with the user in some way. And so that's basically effectively like shrunk the MEV profit dramatically. Something I noticed recently when I was doing a little data diving was that basically there are a number of the probability of a sandwich transaction being negative profit, even though someone submitted a bundle, is actually greater than 0 now. And it used to never happen. You never saw unprofitable sandwich attacks. And so that's coming from the fact that people are basically being lazy and just, saying like, I'm going to bid this amount no matter what, or like their bot has sort of a bug. And they're just willing to do that because it's better to like consistently just be winning auctions and sometimes taking losses on a bundle than to try to optimize how the bundles always win, but your auction sort of precision is lower. And so that sort of is an empirical sign that perhaps, world number 2 will be sort of more prevalent.
Awesome. Makes sense. So I guess let's talk a little bit about just in general cross-chain applications, right? Stepping back and, for everyone that's thinking about how to build cross-chain, how do you design in the space? One question that we recently started to think about with what we're doing with Axelar and some of the partners is the question of whether or not you need to move assets or it's sufficient to move like computation to the assets, right? There's like various ways to build, let's say, an automated market maker, right? Where you can move the assets themselves, have like the code on one chain, or you could still have the assets on different chains and just move some state about them and manipulate them kind of on different chains. So yeah, I guess, hey, are you there, Tarun, or you dropped out? Okay, let me see. Need to promote you. One second.
Hey, sorry about that.
Fix the connection.
Yeah, I'm not sure exactly.
Yeah, Tarun's back. There you go.
Yep.
Sorry, do you mind repeating that? So I heard part of that, which was like you could either move the assets directly or try to do the computation remotely on synthetic versions of the assets and then bring it back. Is that sort of what you're saying?
Yeah, so in general, just thinking about different models of cross-chain compute, right? Either moving the assets to where the compute is, or you can move the compute to where the asset is, and then move it back to the, to like a home base of the compute engine. So yeah, how do you think about those two models? And let's say specifically for like automated market maker, curious if you have any thoughts or opinions. What is the right way to design a cross-chain automated market maker?
Yeah, I think that it's still actually quite up in the air as to what the best design is. I think we've seen some designs that have sort of worked. I would say like by and large, the Synapse bridge has worked from a perspective of they have the most basic thing of they have 2 automated market makers on each side, and they synthetically transfer the assets, and they have representations of both assets on both sides. It's extremely capital inefficient, which is why you have to effectively over incentivize. And so I think there's actually a question of like, well, not only what AMM design works, but also which one is capital efficient. And I think in the cross-chain world, people are much more sensitive about capital efficiency than they are in the single chain world. Partially because people are sort of taking a risk on each, a sort of like non-atomic, in sort of like the asynchronous sense, risk on like waiting for like an asset to go to the other side, or waiting for a computation, a callback from the other side to come back to return. And so I generally think that the most capital efficient model is, of course, being able to outsource the computation away from the asset to a place where it's cheaper to do than on the native asset. But of course, the hard part there is actually keeping the assets pegged, and keeping them pegged costs some amount of capital, costs some amount of arbitrage loss. And so you kind of have this trade-off surface between how well do you keep these sort of synthetic representations that are on the remote chain pegged, versus something where, hey, I'm doing it purely in native assets, but then I have to do this asset transfer, and like there is some risk there just strictly from the volatility between the two assets. And I would argue that that problem is not solved at all. Like right now, what we've done is we've kind of Frankenstein these mechanisms that we do understand into things that have sort of worked. But I suspect the ideal thing will end up being a hybrid of these two, where like under certain market conditions, you end up doing the thing where you send the real asset over, and under other market conditions, you basically ship the computation off remotely. And I think the only way we'll ever be at the point that we can like switch between these two in a confident manner is if like the dominant liquidity for these things is on chain, and sort of each side is able to at least get some partial guarantees from its own virtual machine, its own state, that it's sort of executing that portion correctly. But yeah, I suspect it's going to be messier than the strict AMM, the normal AMM case. It's going to be sort of this hybrid approach of native and synthetic assets, depending on, A, market conditions, B, sort of how much collateral is around on each chain, and C, sort of how good we can get at doing just-in-time collateral dispatch. So, a lot of people talk about just-in-time liquidity as sort of this MEV thing of like, hey, there's a LP pool, someone sees a really big trade, they submit a transaction bundle where they add, a huge amount of liquidity to the pool, execute the trade, so they collect most of the fees, and then remove their liquidity right after. I think people talk about this in like this deleterious manner. It's like stealing from LPs. But there's also a sense in which in the cross-chain world, when you're doing this kind of deferred computation style of thing where you're like shipping off the AMM computation to the synthetic asset on another chain and then returning it, this just-in-time liquidity is actually a very good thing, because you kind of don't want to keep too much of the synthetic asset liquidity around because it's more easily manipulated. And so I think thinking through that design space is the type of stuff that people who are thinking these protocols are going to have to do. I haven't seen any compelling sort of either formal sort of mathematical description or sort of a implementation that has sort of achieved all of those goals, if that makes sense.
Yep, makes sense. So what are some of the most exciting cross-chain applications that you're waiting for?
Yeah, I mean, this is more one that I'm saying more from a purely like, hey, people will use this application. But I honestly think cross-chain lending done in some form where I can put up ETH collateral and then I can borrow an NFT on another chain, or I can borrow the native asset on the other chain, is done in such a way that effectively it's not a taxable sale, just like borrowing against your assets usually is not a taxable sale for US entities. I think that will actually be like a very huge thing, because at the end of the day, it effectively ensures that you're able to move seamlessly between chains without having to sort of do a sale, incur slippage. But also it sort of does a function that a lot of centralized exchanges do, where they're sort of the centralized bridge, which is the way that people move between chains. And a lot of time that's done via borrowing, where they effectively borrow on FTX, where they get leverage and then borrow. And I think like if the cross-chain world plus sort of the DeFi world can provide those tools, I think you'll see a lot of people keep their assets natively on chain. Like a larger number of people will keep their assets natively on chain rather than centralized custodians, especially for people who are new, who have maybe less crypto net worth, but want to use their NFTs in the game, but like, hey, the game is on new chain, they can somehow effectively just rehypothecate by lending their asset to themselves on the other chain. And I just think that that's more capital and tax efficient. And it's not a very sexy application, right? Like I'm sure there's like tons of really pie in the sky applications, but I think it's the one that will like make the decentralized world more appealing to a lot of users.
Yeah, for sure. I mean, I've been personally very excited about this as well, and I think we talked about it for a while. Where even like you have an NFT and you want to take a loan against it, right, or some other chain. I think that's going to be super exciting.
Yeah, and like of course, we're starting to see with things like DeFi Kingdoms, right? Some ways bridges really like enable sort of some games to actually operate and bootstrap more quickly. I don't know what games are compelling, because like I don't really play video games, unfortunately. So like it's very hard for me to understand like what modalities like game designers need. that the cross-chain, the bridge can kind of provide. But I really do think like bridges somehow enable that, because you're bringing in users who are like not trying to do a lot of finance, but they also like have a lot of these assets they want to keep moving from place to place.
Yep, for sure, makes sense. I mean, it's the same as like, layer ones, kind of in the early days, right? When there's no liquidity, like need a bootstrapping mechanisms, and kind of this interop/bridging is what allows them to have this bootstrapping. And I think it's the same for the applications or the games.
Yeah, it's just like we haven't figured those out for the not fungible stuff. So like I feel like that's the open frontier that I think people who are just getting into this stuff, who are interested, should be like thinking about. It's like no one has figured out how to do that, cross-chain NFT type of stuff in a full-fledged form. And I think the bridging tools are really good right now, that you can do tons of experiments as a developer without having to get too in the weeds.
Yep, no, for sure. We actually, one of our developers did a quick demo of how to do like a cross-chain NFT, and it took him an hour, right, just without knowing anything about NFT, and just started from scratch. And it wasn't a full-fledged application, but kind of as a proof of concept of how to do it, it's pretty straightforward to get started now.
Yeah, and it's like amazing when you think like 3 years ago we were doing atomic swaps where you had to wait for like 6-block confirmation, and like you had to write the UTXO yourself. You couldn't really test it. You couldn't simulate it. You couldn't, So we've come a long way, and I think like if you're new to the space, you may not have been able to see that, but like the tooling has gotten like infinitely better, and that will kind of, I think, continue to grow.
For sure. Awesome. Well, Tarun, I know we're about an hour now. Any final closing thoughts or anything else you want to add?
Not really. I think the main thing is just, I'm really excited to see kind of some of these applications built. And I think the world of bridges is just so much richer of a state space, which obviously can be a security and sort of MEV sinkhole, but it also hopefully is an inspirational state space to a lot of developers. And I think it's going to be exciting to see how things like Axelar are able to enable stuff. And congratulations on the Osmosis vote.
Well, thank you. Yeah, that was very fun, and looking forward to that. And for those of you that are listening, if you want to get into building a cross-chain app, go to our website, Axelar.network, check out some of the docs. We have an array of applications from, cross-chain NFTs and like other apps that you can start building and playing with. And, as we were saying, it's much easier now to get started. It shouldn't take more than an hour to have everything locally set up and just start building. So super excited as well.
Awesome. Thanks for having me.
Thanks, Tarun. Talk later. Bye.
Well, that was great from both of you. Thank you everyone for listening today, and see you next time for our next AMA. Goodbye, everyone.